Selling shares in an S corporation to another shareholder involves important legal steps, tax considerations, and compliance requirements that must be handled correctly. Understanding this process is crucial for both buyers and sellers to avoid unexpected tax consequences and maintain the company's S corporation status. An S corporation is a business entity with 100 shareholders or fewer that offers liability protection like a traditional corporation, but is taxed as a partnership. Shareholders report their proportional share of the company's income and losses on their individual tax returns based on their ownership percentage. When selling S corporation stock to another shareholder, there are specific steps to follow. First, update the corporate stock ledger to reflect the new ownership. The stock ledger contains information about all shareholders who own stock in the S corporation. It must include the current owner's designation, details about the transaction, and the person who assigned the stock. The new owner's contact information, phone numbers, and address must be included. Second, distribute Schedule K-1 forms to both the new and former shareholders. The S corporation issues K-1s with information about all profits and losses that shareholders must account for on their personal tax returns. The previous shareholder must include all income and losses accrued before the sale, while the new shareholder reports all income and losses accumulated after purchasing the stock. Third, the new shareholder must document the value of property exchanged to acquire the stock. This amount becomes the basis in the S corporation stock and will be used to calculate taxes when these shares are eventually sold. The basis is typically the fair market value of the exchanged property, or the amount the shareholder would receive if selling those assets for cash on the day of the transaction. Fourth, the selling shareholder must complete and file a Schedule D tax form detailing any gains or losses from the stock sale. If shares are sold for more than the shareholder's basis, a taxable capital gain occurs. If sold for less, a capital loss results. Generally, long-term gains from assets held longer than 1 year are taxed at 15%. When structuring the transaction, shareholders must decide between a stock sale or an asset sale. In a stock sale, the buyer directly acquires the shareholder's interest. The S corporation continues uninterrupted, and the new shareholder establishes a new basis. This approach is common when the business entity and contract should remain unchanged. Alternatively, in an asset sale, the corporation sells its assets to a buyer and distributes proceeds to shareholders. This can potentially create double taxation if S status is lost or invalid. Buyers and sellers must carefully consider liabilities, contract assignments, goodwill, and treatment of intangible assets in both structures. In certain qualifying transactions, S corporations may benefit from special tax treatments. Under IRC Section 338H10, a stock sale can be treated as an asset sale for tax purposes when an S corporation subsidiary is sold as part of a transaction with a corporate buyer, acquiring at least 80% of the stock. Similarly, IRC Section 336E provides comparable treatment when an individual or non-corporate shareholder sells their stock and elects to treat it as if the corporation sold its assets. These elections offer tax planning opportunities but require proper IRS filings. A critical concern when selling S corporation stock is preserving the company's eligibility under IRS rules. Actions that can inadvertently terminate S corporation status include exceeding the 100 shareholder limit, allowing ineligible shareholders such as non-resident aliens or partnerships to acquire shares, or creating a second class of stock through special rights granted to the buyer. If S corporation status is terminated, the business becomes a C corporation, losing pass-through taxation benefits. Shareholders may then face double taxation and additional compliance requirements. When S corporation stock is sold during the tax year, the IRS allows two methods to allocate income and loss between buyer and seller. The pro rata allocation method splits income and loss based on the number of days each party owns the stock within the tax year and is the default approach. Alternatively, the cutoff method allows the corporation to close its books on the sale date, allocating income and loss based on actual operations before and after the transfer. All affected shareholders must consent to use this method, which more accurately reflects operational activity during ownership changes. In mergers and acquisitions, selling shareholders sometimes roll over a portion of their S corporation shares into equity of the acquiring company. Key considerations include proper valuation of rollover equity, maintaining a single class of stock to avoid IRS violations, and preventing unexpected tax outcomes that might trigger capital gains on rolled over shares. To summarize, S corporation stock sales must be properly recorded in corporate records and reported through Schedule K-1s and Schedule D. The buyer's stock basis is determined by the fair market value of property exchanged or purchase price. Transactions must ensure the S corporation remains within IRS compliance requirements. The sale structure significantly impacts tax consequences, and special elections may apply in qualifying transactions. Finally, rollovers in corporate acquisitions require careful planning to avoid terminating SE status or creating unequal tax burdens.